Our session is on the project discount rate. We start with the company cost of capital, the focus of our previous session. This rate typically must be adjusted to arrive at the discount rate to apply to a specific project or business opportunity. One adjustment is for the income tax deductibility of interest expense. A second adjustment is for risk, or specifically for differences in the riskiness of the project compared to that of the firm. A requirement of risk adjustment is to determine the cost that equity investors impose on the project. There are a few ways to estimate the risk-adjusted cost of equity. One is the pure play technique. We show how to apply the pure play approach to estimating the cost of equity and the overall project cost of capital. Then we discuss how to use simulation to develop a project discount rate. Let's return to our formula for the company cost of capital, which is given by the weighted average cost of capital equation. Let's use the example of Crow Hardwoods, which is a firm that takes harvested trees and creates dimensional boards, which it sells to cabinet makers. Here are the relevant financial data regarding Crow. Crow's stock has a beta of 1.2. Crow's bonds pay an interest rate of 4.8%. The current Treasury bill rate is 3%, and the current market risk premium is 6%. Crow is financed with 50% equity and 50% debt. So what is Crow's cost of capital? We're back to our Excel file, and this sheet is entitled Crow Hardwoods. We want to calculate the company cost of capital. The risk-free rate is 3%, the market risk premium is 6%. The financial structure for Crow is 50% debt and 50% equity. Crow's debt costs 4.8% or has an interest rate of 4.8%. And Crow's equity carries a beta of 1.2. Our first step is to determine the required return on equity. So what I've done is to apply the capital asset pricing model to determine the required return on equity. Recall the capital asset pricing model says the required return is equal to the risk-free rate, which I have here in B4, plus beta times the market risk premium. So I've done that calculation and arrived at a required return on equity of 10.2%. Then we can calculate the weighted average cost of capital for Crow using the formula in this arrow, and the result is that the weighted average cost of capital is 7.5%. If Crow is a tax-paying entity, its net cost of debt is actually lower than the rate it pays in the market, because income tax deductibility of interest expense lowers the net cost of debt, or the net interest rate on debt, to the borrower. So we have a new adjusted weighted average cost of capital formula to take account of the income tax deductibility of interest expense. If Crow's marginal tax rate is 35%, what is its tax-adjusted weighted average cost of capital? We're back to our Crow Hardwoods worksheet. The before tax calculation that we just did resulted in a weighted average cost of capital of 7.5%. Now we need to reflect the marginal tax rate of 35% that Crow pays. So down here we have an after-tax calculation of the weighted average cost of capital, and you can see that what I've done is to apply the formula in this arrow and you can see the pieces of the formula or the components of the calculation. So what we do is to take the cost of debt times 1 minus the marginal tax rate times the debt financing ratio plus the cost of equity times the equity financing ratio, and we arrive at a weighted average cost of capital that is adjusted for the income tax deductibility of interest expense. So the existence of income tax deductibility of interest expense is actually a subsidy for debt financing that lowers the net cost of debt to the borrower, that is to Crow, and it also lowers the overall weighted average cost of capital for the firm. Crow's company cost of capital adjusted for taxes is 6.7%, as we just found. This rate is the starting point for the project discount rate. Now, Crow Hardwoods is considering integrating vertically by creating a division that will manufacture cabinets. What is the correct discount rate to use for Crow to evaluate this project? If cabinet manufacturing has the same business risk and has the same financial risk as Crow's overall current business operations, then the correct project discount rate is 6.7%, or the tax-adjusted company cost of capital. But if cabinet manufacturing has either a different business risk or a different financial risk from Crow's current business lines, then the project discount rate is not 6.7%. The project discount rate depends on the project business and financial risk. Let's define these concepts. Business risk is the risk inherent in the project or business. It is the risk associated with the project's assets. Such risk might derive from the market conditions associated with the project, or from the production processes involved in the project. And business risk is reflected in or measured by asset beta. Financial risk is the risk due to the capital structure of the project or the firm as a whole. Recall that capital structure is defined by the percentage of assets supported by debt and the percentage of assets supported by equity. Financial risk is reflected in the difference between asset beta and equity beta. In general, financial risk will be higher the higher is the debt financing ratio for the project in the business. That is to say, financial risk is higher if the firm has more debt financing. To determine a risk-adjusted discount rate, we need to adjust the components of the weighted average cost of capital formula for the risk of the project. Here are the components. First, the capital structure of the firm, or the target capital structure of the firm after project adoption, which is measured by the debt and equity financing ratios. Second, the marginal tax rate of the firm. Third, the cost of debt, or the interest rate that lenders charge to finance the project. Now, the cost of debt depends on the business risk of the project and the financial risk of the project. That is, lenders will require higher interest rates for projects that consist of riskier businesses. They will also require higher interest rates if the projects are financed by higher percentages of debt. Now, the good news is that the cost of debt, the risk-adjusted cost of debt, can often be determined in the market. That is, you can often find out what interest rate lenders will charge to finance the new project or new business because they're able to assess the relative riskiness of that business. But it's more difficult to determine the cost of equity for the project. The cost of equity is the return required by equity investors in the project. It depends on business risk and financial risk, just as does the cost of debt. Equity suppliers or equity investors will impose a higher required return for projects with higher business risk or for projects with higher financial risk, that is, for projects that have higher debt financing ratios. Sometimes the cost of equity can be estimated by reference to comparable firms. This approach is often called the pure play approach to estimating the cost of equity. And sometimes the cost of equity can be estimated through simulation or scenario analysis. We'll look at both of these methods. The use of the pure play approach to estimate a project-specific cost of equity involves identifying publicly traded firms with the same business risk as the project. Such firms operate only in the project's industry or mainly in the project's industry. One can obtain the equity betas for these comparable firms either from the beta book. Yes, such books do exist and they make engrossing reading, or by conducting a regression analysis of the returns of the firm's stocks in relation to the returns on the stock market overall. The output of such a regression analysis is a beta coefficient estimate, or the equity beta of the firm. Then one unlevers each comparable firm's equity beta to get the asset beta by applying the formula for the asset beta. Note, to apply this formula one needs the firm's debt beta as well. Some financial economists assume that the debt beta is 0. A more precise approach is to calculate the debt beta from the information given on the firm's debt. The next step is to take the average of the comparable firm's asset betas to get the industry asset beta, which reflects the industry's business risk. This industry business risk is taken as an estimate of the focal project's business risk. Therefore, the industry asset beta is an estimate of the project's asset beta. The project asset beta is then re-levered using the firm's target capital structure after the project's adoption. To get the project equity beta, here is the re-levering formula. Next, one applies the capital asset pricing model to the estimated equity beta to calculate the required return on equity for the project, or the risk-adjusted cost of equity. And here's the capital asset pricing model. This is also the return, this cost of equity is also the return required by the equity investors to compensate them for the cost of the project. Finally, we calculate the risk-adjusted discount rate using the formula for the weighted average cost of capital. Note that this rate that we calculate reflects both the business risk of the project and the financial risk of the firm with the project. If the net present value of a project's cash flow discounted at this risk-adjusted discount rate is positive, the project is expected to generate enough cash to cover its operating costs, to cover its financing costs, including the interest on the debt and the return on equity. And these financing costs include a risk premium sufficient to cover the risk of the project. Let's revisit our Crow Hardwoods example to see how this pure play approach can be applied. Recall that Crow has been in the business of producing hardwoods for the cabinet making industry. It is considering integrating downstream vertically into the cabinet making business. To value this business opportunity, Crow can apply a risk-adjusted discount rate. Crow has decided to apply the pure play technique to estimate a risk-adjusted discount rate. For simplicity, and to demonstrate a pure play procedure slightly different from the one we just covered, let's start with the average equity beta for the cabinet industry. One can get industry equity betas as well as individual firm equity betas. The cabinet industry has an equity beta of 1.6. Materially higher than Crow's equity beta of 1.2. This higher equity beta reflects the higher risk being borne by equity investors in the cabinet industry because the firms in that industry have higher business risk or higher financial risk or both. We start by unlevering the equity beta by applying the unlevering equation to available information on the capital structure of the cabinet industry. So here is the unlevering equation, and here is the capital structure of the cabinet making industry. Note that on average the cabinet industry firms have more debt than Crow. In general, this means that they have more financial risk. We also have information on the average debt beta of the cabinet industry, as well as the average marginal tax rate. Applying the unlevering formula here to these numbers results in an asset beta of 0.88. Because this asset beta is higher than the asset beta for Crow, which we found up here as to be 0.7, we conclude that on average the cabinet firms have higher business risk than does Crow. So if Crow creates a division to enter the cabinet industry, it will be increasing its business risk. Now let's calculate the equity beta for Crow's investment in the cabinet business by relevering at Crow's capital structure. Here's the relevering formula, and here's Crow's capital structure. Applying the relevant numbers, we get an equity beta of 1.46, somewhat higher than Crow's original equity beta of 1.2. This higher equity beta reflects the higher business risk of the cabinet industry. Next, we apply the capital asset pricing model to get the risk-adjusted required return on equity for Crow in the cabinet business. The calculation gives us a risk-adjusted return on equity of 0.118, higher than Crow's original required return on equity of 0.102. This higher required return on equity compensates Crow's equity investors for the higher risk for investing in the cabinet business. Finally, we calculate the weighted average cost of capital of 0.074. And that is the risk-adjusted discount rate that Crow would use to calculate the value or the net present value of investing in the cabinet business. Let's review the process of using the pure play approach to determine a project's risk-adjusted discount rate. We start with the company cost of capital calculated as the weighted average cost of capital adjusted for the income tax deductibility of interest expense. And for Crow Hardwoods, this process gives us a rate of 6.7%. Then we risk adjust that discount rate as necessary to reflect the relative risk of the new business proposal. The risk-adjusted cost of debt is often available from the debt markets. That is, lenders will tell you what they will charge to finance an investment in a new business. The risk-adjusted cost of equity can be estimated using the pure play approach we just covered. We need to use the financial structure of the firm after project adoption, and we calculate the risk-adjusted weighted average cost of capital, or the firm's risk-adjusted discount rate. Crow's cabinet project risk-adjusted discount rate was found to be 7.4%. So now, just to review, we take this 7.4% and use it to calculate the net present value of Crow's investment in the cabinet project. If the NPV is positive, the cabinet project is expected to generate enough cash for Crow to cover its operating costs, to cover the cost of debt as measured by the interest rate of 4.8%, to cover its cost of equity at 11.6%, and remember, the required return on equity includes a risk premium to compensate for the higher risk of the cabinet business. And the positive NPV means that there is some additional cash value for the firm and wealth for the firm's shareholders in an amount equal to the net present value. A second method of estimating a project discount rate that we introduced briefly in an earlier session is to use simulation analysis or scenario analysis to assess project risk. So we conduct a simulation or scenario analysis as we discussed in an earlier session. That analysis results in determining an expected net present value for a new business proposition, a standard deviation of net present value or a measure of risk, and a coefficient of variation of the net present value, which is equal to the ratio of the standard deviation to the expectation. Recall that coefficient of variation is a measure of relative risk. So it's a measure of the relative riskiness of this new business proposition that we can use to compare to the risk of the firm's current business lines. Please refer to our previous session for how to calculate the expected net present value, standard deviation, and coefficient of variation. Once we have the coefficient of variation of the net present value for the proposed project, we can use it to adjust the debt and equity betas of the firm for the relative risk of the project as reflected by the coefficient of variation. And specifically, what we want to do is to calculate a risk-adjusted required return on equity, a risk-adjusted required return on debt, and finally a risk-adjusted weighted average cost of capital. Note that the risk-adjusted required return on debt may have already been determined by the lenders, and they may have given you an interest rate that's already risk-adjusted. As an example, let's return to GM's evaluation of Project Green that we introduced in a previous session. Let's say that GM conducts a scenario analysis or a simulation analysis and finds that the coefficient of variation for Project Green is 50% higher than that of GM's current business lines. To determine the risk-adjusted discount rate to apply to Project Green, GM can adjust both the beta on debt and the beta on equity, and that would be done by multiplying beta debt and beta equity for the firm by 1.5, calculating a risk-adjusted cost of debt and cost of equity. And note that I put the numbers in here, and I'll show you how I've calculated those in a bit. We calculate the risk-adjusted cost of debt and cost of equity using the capital asset pricing model. Then we calculate a risk-adjusted discount rate, which is a weighted average of the risk-adjusted cost of debt and the risk-adjusted cost of equity. And we apply that risk-adjusted discount rate to the likely case cash flow scenario to find the net present value adjusted for risk, which turns out to be $36 million. Here's our spreadsheet showing the evaluation of Project Green by GM. Our previous analysis had Project Green with the same level of risk as GM's current business lines. Now we're assuming that Project Green is of higher risk. And we've done some analyses based on simulation or scenarios that indicates that the coefficient of variation for Project Green is 50% higher than the coefficient of variation on GM's current business lines. So we need to adjust the equity and debt betas up to reflect that higher coefficient of variation. And we do that by multiplying the equity and debt betas for GM by 1.5 to arrive at risk-adjusted equity and debt betas for Project Green. You can see our higher beta numbers. Now we can take the risk-adjusted, let's say, equity beta and calculate a risk-adjusted required return on equity for the new project using the capital asset pricing model. And that's what I've done in this cell. We can do the same thing to calculate a risk-adjusted required return for debt. And finally, we can take these numbers and calculate a weighted average cost of capital, which is the weighted average of the cost of debt and the cost of equity using the financing ratios for GM after project adoption. The result is a risk-adjusted discount rate of almost 15%, 14.8%. And notice that rate is considerably higher than GM's company cost of capital, which is about 11%, because this business line is much riskier than GM's current business lines. Now GM can take this 14.8% project discount rate and use it to evaluate the cash flows or the cash flow projections of Project Green. Here are the cash flow numbers once again. You can see that the initial investment is $300 million. and the project generates a positive $100 million each year for the next 5 years. Here's our net present value calculation. And you can see now that I've used the risk-adjusted discount rate or risk-adjusted weighted average cost of capital of 14.8% in the net present value calculation. The end result is a net present value of $36.5 million. Now note that what has happened is we've determined a risk-adjusted discount rate for Project Green, which is much higher than the discount rate for General Motors overall, or General Motors Company cost of capital. Applying a risk-adjusted discount rate results in a much lower net present value of the new project than if we were to apply the company's cost of capital. The reason for the lower net present value is that both the debt and the equity investors in this project have required higher rates of return to compensate them for the higher risk associated with the project. But our positive $36.5 million indicates that Project Green is still a worthwhile investment for General Motors. In fact, the $36.5 million net present value means that Project Green generates enough cash to pay the debt investors 10.3%, to pay the equity investors 17.8%, plus an additional $36.5 million that goes to increasing the value of the firm, that is General Motors, to its shareholders. Hence, the effect of adopting Project Green by General Motors is to increase the wealth of the shareholders in the aggregate by $36.5 million. And if we wanted to calculate the effect on GM stock price, we could take this $36.5 million net present value and divide it by the number of shares outstanding to determine the increase in the price of a share of stock associated with this new business opportunity for General Motors.